So hello once again, everyone. Thanks for joining us. This is Steve Taylor. I'm the lead advisor and founder of Merited Wealth. And thank you for joining us in another episode of what I like to call Thoughts in Growth Mode. And in this format of podcast, I like to really bring on an expert and talk about a topic that I think might be interesting to you, the listeners. It's something that I find interesting, something that I run across, a lot, and kind of go through it and try to give just some tips and tools to use that you might be able to help and apply to your everyday life, or if need be, enough to get you dangerous, and then kind of reach out to an advisor or somebody that might be able to help you. But anyway, I wanted to introduce our guest today, and he can give us a little introduction, a little bit of his background, and then we'll hop into this topic, which I think is a very, very timely topic for where we live. Ernie Diaz. Ernie, tell us a little bit about yourself.
Well, first of all, Steve, thank you so much for having me. I appreciate the opportunity to come share with you on the podcast. I've definitely heard great things, and it's a tremendous medium that you have. So I work at BDO USA. I've been there approximately 8 years in the private client services industry. I service high net worth individuals as well as foreign nationals coming in looking to invest in the U.S.
Excellent. So Ernie, let me start us off, and we'll talk about it. Kind of an example and situations that you find where these issues that we're going to talk about here that may come up. But Miami is and always has been a melting pot, right? We have people coming in from South America, but really all over the world now. Eastern European, every people are coming from all over. And they come over for many different reasons, right? Maybe one of their children came over first. Maybe they came over in vacations and they want to stay and they wanted to spend more time. But talk a little bit, about, your, like we said, your area of specialty is those foreigners who are coming in. What are situations or instances that you see that when they come down and they sit into your office that they really have started to look into and to make this move, whether it's to follow a child, whether it's semi-retirement, whatever it might be? Kind of what are some examples, or maybe the most common one that you see that people are looking to make this move, that they're not U.S. people, but they're looking now to become more U.S. people?
Yeah, absolutely. I think that's a great question. And to preface a little bit what you said, having a lot of Eastern Europeans and South Americans and Central Americans coming into the U.S., I think the key component that I've seen is education and knowledge, being able to transfer that wealth, because they're coming here generally, to save their money. It could be for political asylum. So there's different facets of why they're coming here. So coming into a new country and understanding the tax laws is not something that is done one day to the next. It's a very complicated thing. One of the most common scenarios that we see is foreigners either from Central or South America coming into the U.S., predominantly Miami, perhaps the Midwest, and buying pieces of real estate and or operating companies. A lot of times these investments are vacation homes, but they're also components of how to save wealth, how to have wealth, essentially in a fixed asset here. The majority of the times, if the investment appreciates in value substantially, which we've seen in the real estate market very recently here in Miami, specifically during COVID, there's opportunities to sell. And with those opportunities to sell, if you're not structured properly in an investment component, you're going to have to deal with some tax ramifications. And in a simple term, if you come here as a U.S. as a foreign investor, perhaps you and your wife, and you buy a piece of real estate and you own it outright, the moment that you sell that piece of real estate, the IRS is going to come knocking on your door, and they're going to want 30% of that sales price as a withholding. You have the opportunity to come in and file a tax return after and kind of claim your refund. But that's all avoidable. That's all avoidable by properly structuring yourself with U.S. entities in order to avoid that. That saves, first of all, it saves money, it saves cash flow, and it has the investor in a much happier place at the time of sale.
Yeah. So I think that's exactly how I've seen it for my many years working with foreigners. They come over, they love it here. Maybe Miami somewhere else, and they say, I'm just going to go buy a property, right? This is wonderful. This is going to be a second home and everything there. And what I've seen and what I've experienced, and maybe if there's some non-US international people listening here, is that first discussion for these items that you bring up, right, about how the IRS taxes and how the rules work. The common reaction I get, well, it's not like that in my country, right? This is nothing like that we're used to, or nothing like that we've seen. Talk me through and walk me through a little bit. How do you introduce really many times what's a new concept to these people, and they're that they can be very hesitant to accept and listen to, and many times they might just leave your office and say, well, forget it, I'm just gonna I'm not gonna deal with this, that's someone else's problem. How do you help them get comfortable with this foreign body of rules, and to kind of help them realize that it's probably in their best interest to do some planning?
Yeah, I think that goes back to that ultimate component of education, right? So they're coming here for a reason. And if you look at a global level, you have the country of Colombia taxing high amounts just to take dollars out of the bank account. You have countries like Denmark with exorbitant tax rates. South America is somewhat in shambles, right? You have Venezuela with the political issues. So there's always a reason why they ended up in the US. So when you break down the numbers are typically in their favor. But having an understanding of saying, hey, listen, ultimately, you're right. It's completely different than it is in your home country. It doesn't necessarily mean it's better, but there's more opportunity here to mitigate taxes. Can you imagine, going into the bank and saying, hey, I want to withdraw $100, and there's a fee, a 20-30% fee. If you pre-plan this, you can make your journey into the US, and that's what we call pre-immigration planning, and kind of plan this out where you take one hit, withdrawing those assets from wherever it may be overseas. You can kind of pre-plan the liability or the incurrence of that fee per se. I think understanding that and explaining that to them in a way that they feel comfortable is the best approach, because a lot of different clients don't feel comfortable with everything that you say. Everybody's very different. Everybody has different culture. I think that's an important part of understanding, and also speaking their language, not just speaking Spanish or French or Italian. It's not about that. It's about how do they do business, and I think it's a huge component.
Yeah, that's a great point, Ernie. I love that. Speaking their language, not necessarily whatever the dialect may be, right? But understanding where they're coming from, understanding where their mind is. Because entrepreneurs, business owners, or people wanting to grow wealth, that's kind of a universal language, right? That's around the world. So let's walk through briefly. We'll talk about a scenario where someone does come before they bought that piece of property, right? Because unfortunately, we'll talk about that second, about nine out of 10 times, that's not the case, right? Oh, yeah, I have this property, or I have multiple properties. But talk about if someone happens into your office, they decided to get the good advice, and they understand that the different rules apply, and someone's coming in to the US, and maybe whether to start by investing in a piece of property or start moving some of their businesses over. What is kind of the process, and what are some of the steps that you kind of put them through, and that they have to do to this pre-investment, we'll call it, many times use pre-immigration planning?
Yeah, I think that's a great question. And like you mentioned, that rarely happens where you have such a clean slate with a client where you have the opportunity to kind of give them all of the tools in the toolkit, right? But let's assume that does happen, right? So you have investor A and B, perhaps they're married and they'd like to move to the US. So they'd like to obtain that green card and kind of and live over here. But it's a process, right? So ultimately, let's say the first component of this is buying a piece of real estate. Well, the last thing you want to do is buy that piece of real estate in your own name. So what you would open is a US LLC tentatively. You could have that LLC, be taxed as a C corporation in the eyes of the IRS, generally favorable to foreigners. You buy that. You need to identify with the IRS that you have these filings. You're going to be able to file these tax returns. Second component of this is going to be some sort of a bank account, a banking vehicle. You're going to need what they call a tax identification number. That's going to need to be a component in what you submit to the bank. And that's going to tie the entity to the IRS. If for whatever reason you have large holdings in your home country and you still want to move to the US, and we see this all the time, that's okay. You don't have to get rid of everything, generally speaking, but you're going to have to be able to comply with the US tax laws and making sure that all of those foreign assets or operating entities, a lot of times these individuals have, various and very successful operating companies. So the moment that they become US people, yes, for the majority of this, they've transferred substantial amounts of cash, perhaps real estate holdings into the US, but they don't want to get rid of their business, right? They have a tie to the home country. They have a tie to their bread and butter of a business. So what do we do? Well, there's different options, right? There's different tax credits that you can be able to take. There's also different regimes. One of the last, I guess, most prevalent regimes is what they call the GILTI tax regime, and it was enacted in the Tax Cuts and Jobs Act in the last presidency. Ultimately, what it allows is, the foreign entity has to be taxed to the U.S. person. So at that point, the foreigner becomes a U.S. person. They have to, file an income tax return and kind of pay those taxes. So the compliance is tedious, but it doesn't end. And I think as a component of coming into the U.S. and wanting to save that opportunity, it doesn't get you away from neglecting the fact that you still have operations overseas. There's still opportunity to save money. One of those can be in the area of research and development. So if you have these foreign companies and you say, well, I want to become a US person, I don't want to be able to get rid of those operations, and there may be benefit. And one of those benefits is utilizing those specific credits for research, right? So those are, one of the components. Another component that needs to be looked at is, how many foreign bank accounts do you have on a global basis, right? The moment you become a US person, the IRS kind of wants to know, unfortunately, all of your holdings, in the excess of $10,000. So it's another tedious measure, but it is something that needs to be addressed because there are, somewhat penalties involved if these are not addressed. So coming into the US has substantial benefits, and there's also some compliance. I'd like to just add a moment, there's sometimes that investors or foreigners want to come in, but they don't want to become US persons. There's still a huge tax planning aspect of this. For example, let's say, as I mentioned earlier, Denmark has a 52% tax rate at the highest, right? You have a CFO, a CEO that's working for, a multinational company coming in, and they want to live in Miami because Miami's nice. There's no income tax here at the state level. But they don't want to pay double tax to the US government. There's opportunities to utilize tax credits to kind of defray some of that component at the European level. That's a huge thing that's often, sometimes overlooked. It is somewhat of a simple concept, but it is very, very powerful. The other component is utilizing, tax treaties between various countries. Canada has a tax treaty with the US, so does Japan. So these are components where there are tax savings for specific types of income, interest, dividends, royalties, things of that nature. So those are the opportunities that I think need to be looked at a global level when a client is going to sign on and kind of say, hey, I'm an open book. What can we do to save some taxes?
So let me ask you, Ernie, I think you bring up a great point. It was a question that I was going to ask. That whether the person does or does not want to become a U.S. person. So as at its basic level, right? Whether it's the substantial presence test or whatever it might be, how does a person become a U.S. person, and kind of how does many times they violate that and they become a U.S. person without really understanding that they did.
Yeah, I think the big thing there is intent. If you're going to be, a U.S. person, you want to follow that cookie cut example. What you said, the substantial presence test is kind of it's you hit the nail on the head there. So ultimately, more or less, it's 183 days that you have to be here over a 3-year period. There's a formula involved, but that's kind of the magic number. A lot of times, if you're not keeping a log with your passport, you can come into those days and you're going to have a happy morning one day when you wake up and you realize that you're a U.S. tax person. It's not going to be that great ultimately. So how do you avoid that? I definitely come across clients that we call them nomads, because they fled a country for either political reasonings and or financial reasonings, and they're just trying to defray tax at a global level. So unfortunately, it's a little complicated because they have to be various places throughout the year. They can't sit in one jurisdiction because, like the US, there are other countries that have, tax regimes, and they want their dollars as well. So one of the things that you can do is keep a log, right? Open that passport that you have and make sure that you're not exceeding those days. That's a huge thing. In addition to the substantial presence test, there are other tests that are involved, a little bit more complicated and over the scope here, but I think that it manages intent. So let's say you have a family, you're living in Mexico, and you decide to come to the US, buy a beautiful condo on Miami Beach, and you're here 300 days. Well, the IRS is going to come to the conclusion that you didn't go back to Mexico, you sold your assets in Mexico, you have nothing in Mexico anymore. Your intent is to be a US person. That intent is very important and can cause you to be a US tax resident ultimately.
Yeah, that's a great point, Ernie, and maybe we can put in the show notes here a link to the substantial presence test, because many people they think it's just for the current year that the numbers accounts. Like, no, it takes a portion of the previous few years and puts them together. And yeah, you have to be very, very, very careful. I know advisors, you probably do, and I've seen other international advisors that do those calculations and keep track for clients. So.
Oh, yeah.
So, Ernie, another item that you brought up when you started, when you said number one, when they're doing the pre-planning, right, that they come in and they start and they open up an LLC, and I believe you mentioned a U.S. LLC, but I think many people, there's a lot of information that goes around, and many people talk about, well, for various reasons, it may want to be a non-U.S. entity, right? Whether Bahamians, whether Cook Islands, whatever they might use. Can you say real briefly the goals of why this person may want to choose a non-U.S. entity rather than a U.S. entity? Because I know there's a lot of information that goes out there, and I'm sure certain people say, well, you must do it this way or the other way. But how would you speak to that about what the jurisdiction of that entity is?
Yeah, absolutely. I think, in the component of opening a U.S. LLC and having it taxed as a corporation, it has strictly to do, not strictly, but very importantly to do with U.S. real estate. It defrays that FERPTA 30% withholding. But to your point, opening up an LLC foreign or a foreign corporation presents a blocker for you, and it saves you from the U.S. estate tax, right? So now you have a foreign person owning a foreign corporation, which happens to own stock in a U.S. corporation. So if for whatever reason something were to happen to that foreigner while in the U.S., and they're not a U.S. person, right? The estate tax would apply, and the estate tax is not that friendly to foreigners, right? For U.S. persons, it's in the excess of $11 million, but for a foreigner, it's only $60,000 of a threshold ultimately. Opening up that foreign corp allows essentially the estate tax not to apply to that specific asset, right? Because you have ownership in a foreign asset. So that's one of the main components to your point. So that's
so they really, to your point, they really need to make that decision whether they intend to become a U.S. person or not, right? Because that's going to dictate a lot of the planning that they do, after that, that hopefully when they come in and do it. But so we've talked about this ideological, foreign client that came in, they were doing it the right way. They were trying to get it done and cross their T's and dot their I's. But in reality, that it almost never happens that way, right? And so unfortunately, people will come in and they will have they've already rung the bell, so to speak. They bought that property, right? And whatever else it might be. So in those situations, I know those are hard conversations. That was one of my first jobs out of law school. I was at an international law firm and having those conversations. Those are really tough. Like I saw the lawyers, that, granted, everyone practices it differently, but they start, figuring out the fines and the taxes, and those went above the value of the property, right? Now that's an extreme situation, but what would you say for, this individual that's come in, they've already bought it, right? They've come in and now they've realized, hey, there may be more to this than we think. what's your kind of process there, and what's the advice for the person to say, hey, listen, you probably need to be aware of this. You need to kind of clean this up because there's problems down the road that are going to be very painful.
Yeah, I think that's a really good question ultimately because it's very practical. And I think the first thing that you have to do is set expectations, right? Set expectations as to what the course of time is going to do based on the investment. Not so many times do they come in and tell you that they bought the property. A lot of times they've told you that they've sold the property under a current structure where there was no entity involved. And then you get a phone call from the attorney, and the attorney's asking about FERPTA withholding, and the client is not a happy camper because they have to fork over generally large sums of money to the IRS, even if the property was sold sort of at a loss, right? So ultimately, what do? You get a really good tax
Ernie, can you
attorney.
explain that real quick? First, I think a
Yes,
lot of people don't understand that withholding kind of where is the withholding done? At what point is it? Because this is a great point, right? This is someone
absolutely.
under contract or talking to their closing agent, and all of a sudden, ¿qué pasó? Right? This
Right. ¿Qué pasó?
yeah, yeah.
Exactly.
Can you explain a little bit what that means? The shot
Sure.
there.
So, FERPTA is a regime here where the IRS is able to tax and withhold 30% on interest, royalties, rents for foreigners that are doing business here, right? And generally, if you have a U.S. Property interest, U.S. real property interest here, and you own that outright, even if you own it in an LLC without any corporate structure involved, there's generally going to be a withholding, right? So what happens is at the moment of sale, the attorney is generally the closing agent in that sense. They will have to withhold an amount of the proceeds and send it directly to the IRS. It doesn't just happen with real estate. It happens if foreigners are trying to open brokerage accounts here as well. There's generally a withholding involved. And that also, it presents the opportunity, or I guess the consequence ultimately, for that foreigner to have to file a U.S. income tax return as a non-resident to sort of claim any of that withholding as a refund if it applies. So FERPTA it creeps up on you. And unfortunately, in recent times, in the last few months, we've had to deal with some clients that have had real estate sold. And unfortunately, it's a little complicated explaining to them. Now, did they get their money back? Yes, absolutely. There was tax returns filed, refunds were received, but it extends the time of ultimately the reward of your U.S. investment.
Yeah. So that's that FERPTA withholding, that's where it kind of it catches them. And so if someone does get that unpleasant call, or understand they're selling this property, and the closing agent tells them we have this requirement, the holding and stuff like that, and they come into you, what typically happens then? What do you advise? Kind of what do they need to do? Let's say typically many times these are foreigners that own the property, but they've never filed any kind of tax return in the U.S., right? Because that's just kind of
Right.
how it happens, whether intentionally or unintentionally. Kind of how does that process look?
So that's a loaded question, right? So ultimately, you have to figure out the component of risk, right? And we won't dive too much into that, but if there hasn't been any filings, you need to analyze the structure and see if there's necessary filings. But that question always goes over to what was the property used for, right? Were you living in that property? Were you renting that property? Was there any income generation from this, right? A lot of times, these foreigners will say, well, I had the property rented through, a a component of Airbnb or a VRBO, and, I was depreciating the property. And you ask them about ultimately, providing proof of tax returns. They don't have them. So, you can't claim the depreciation with the IRS if there was no tax returns filed. So you analyze the risk component, I think, and see what the best way forward is. As far as the actual FERPTA withholding, there are various forms that need to be filled out and provided to the closing agent. And subsequent to that, you can claim your refund. I do think that there's also another component involved is, do you have any, it's kind of off on a tangent, but do you have any U.S. children? Do you have any children that were born in the U.S. that were utilizing this property? The burden of proof will fall on them and kind of perhaps gives the foreigner an opportunity to not have to comply in certain aspects. So it's a little nebulous in that sense, but it is an opportunity.
Got it. Got it. So Ernie, we focused a lot about the aspects if you buy and you sell real estate, right? If you kind of did that before you came over. But let's talk a little bit about someone, a foreigner that's come over and they rent, right? They rent whether a part of the year, you know, the full type of the year. They want to spend more time here, but they potentially, you know, they don't think about they're not going to really divest of their other foreign assets. They get their income. They're not necessarily going to be opening up U.S. bank accounts or any items like that. And probably maybe this would maybe be Canadians, right? Because it's so easy to get here, right? And they come down, you know, all the time. What are some thoughts and ideas for people like that they haven't bought the real estate, they haven't opened up the bank account, or maybe in my Canadian example, maybe they have a TD account, right? That's open in Canada and they're able to access here in the U.S. What are some of the things that that you see or that they might want to think of, even though they have not made this big investment, but they're spending a lot of time here, and what are, you know, maybe some examples you've seen of something that might pop up and kind of bite them in the rear unexpectedly?
Mhm. Yeah, I think that's a good question ultimately, and it all goes back to, you know, substantial presence, right? So depending on how long they're here, they may be subject to that tax even as part here. So if the Canadian, you know, jurisdiction is taxing them, ultimately, I think that there's a tremendous opportunity to go into the tax treaty and kind of see where there are savings, right? Where do we have opportunities that there's a reduced rate, right? That's one side of it. And the other side of it is if that person or persons are coming into the US perhaps for tremendous job opportunities, they're also being taxed in Canada. There's definitely an opportunity here to utilize foreign tax credits, right? That's huge. A component of, you know, you mentioned renting, right? So if that person ever wants to transition into being full time, perhaps they need to show more intent, kind of, you know, changing their driver's license, changing their, you know, automobile vehicle registration, you know, becoming part of the Rotary Club, things of that nature. On a part year basis, it's just a timing game, making sure that you are not in one place for too long, unfortunately. And if you are, making sure that you utilize the tax credits and the tax treaties. That's what they're there for. And definitely, you know, among Canada and Mexico, there's definitely good relationships. And there's multinationals crossing the borders, you know, all the time, right? I think it's important to kind of educate these high net worth individuals that are crossing, trying to mitigate and divest, so that they can kind of have a lot of opportunities to say, hey, listen, yes, I'm being taxed in Canada, but it's not so bad in the US because of X, Y, and Z. I think that's a good opportunity.
Yeah, yeah, I see it all the time. You brought up before, which is a great point, about intent, right? Where's your intent to leave? And because this comes up not only in international, but in U.S. also to determine where your domicile, like what state you're in. That if
Mhm.
someone goes in and change their car tags, right, or maybe wants to get a driver's license, there is a potential massive repercussion in
Huge.
that simple act, which they may not have realized. And so anybody, you know, that's done that or looking to do that, that's really a great time to sit down and kind of get that advice.
Absolutely.
Yeah.
Absolutely.
So Ernie, you know, so we have, you know, we've gone through a little bit, you know, these different scenarios and different items out there. So, you know, I guess maybe, you know, summing it up and going through it, whether, you know, these international individuals when they're thinking to come over to take part of the American dream or not, what are maybe some final departing thoughts on kind of what do you think are like best practices, things that come up a lot, like maybe a time frame before they should start reaching out, or a time frame after they've already been here? What's kind of you know, if you could talk to a pool of people out there that you feel that they may have some concerns in your area, what are some thoughts and words you would tell them about these issues?
Yeah, absolutely. And I think it goes back to education, right? The moment that you have the slightest inkling, and you see it all the time, the slightest inkling that you want to be a US person or you want to have substantial holdings in the US for whatever reason, political instability, financial insecurity, whatever it may be. You have family in the US. The first thing is education, reaching out to your advisors in your home country. Generally speaking, they will definitely have good relationships with US counterparts. That's been something that I've seen, whether it's a CPA or the equivalent, a tax attorney, or perhaps even a partner. Ultimately, I think that's a huge thing. The second thing is looking at your timeline, right? Getting a green card is a tedious process, right? Making sure that if you have holdings in that foreign country, wherever it may be, what is it that you want to take? Taking cash is easier than selling property. Maybe it's not, right? So making sure that you understand your guidelines in your own foreign country. Do you have the opportunity just to take $2, $3, $4 million out of that country from one day to the next? And once you take it out, where are you going to put it in the US? Opening up substantial brokerage accounts at the like, at JP, at TD, all these big banking institutions ultimately is a tedious process, right? Ultimately, it provides huge opportunity for learning moments, and it brings the CPAs and the investment advisors and the attorneys all together to provide tremendous advice to these foreigners. In addition to that, a huge component of this is there any U.S. children involved in this? Because if there is, it almost preempts this. It almost fast tracks this process for you, unfortunately. So in a quick example, if you have any U.S. children that you've given any assets to, it presents a problem, right? Those people have inherited assets now. There may be some sort of filing requirement that they need to disclose all this information. So I think it's very important in three steps is, what is the intent? What is it that you want to bring over? And what is your timeline? How quickly do you want to have this accomplished?
Yeah, Ernie, I think I love that thought and that advice that you just gave there, in that to have these people reach out to their advisors, the people they know, like, and trust in their own country, and allow them to make a connection. Because I know so many times in these conversations over the years, you're meeting these people brand new. They don't know you from Adam, right? And especially in Latin American countries, right? It's very much about trust and word of mouth, right? And they're like, who are you and why should I listen to you? And that becomes really low likelihood that they will take the steps that they need to. But I absolutely love that idea that their first step should be go back to who like, and trust, and get their recommendation, right? And that could really make the process less painful, and kind of make them more, get them more of where they need to be, right? That's what our business is about. Ernie, listen, this has really been awesome, man. Like I said, for those of you listening, we're going to try to put some information there about the substantial presence test in the notes, and we'll also put Ernie's information. And if you have any questions about this or anything else, or any topics, if you've listened here to the end, right? If you're one of those great troopers, thank you. Email me, let me know. Is there other topics you want to hear about? Do you want to hear about this topic more? Whatever it might be, email us at podcast@meritedwealth.com, and we'll get it on there. But Ernie, listen, man, I really, really appreciate your time. And I thought I found this very helpful, and I hope anybody who's listening here does also.
Thank you, Steve. I appreciate the opportunity.
All right, buddy.